Good afternoon. We're talking about adjustments for adjusted gross income. There are several of these, and they really span a lot of different areas. For starters, we have student loan interest. For student loan interest to be a deduction for adjusted gross income, it must be on a qualified education loan, it must be for qualified education expenses, and then the full amount is deductible until adjusted gross income reaches $65,000 for a single taxpayer or $130,000 for those married filing jointly. There are also health savings deductions, and these are a bit different. So for health savings deductions, it's healthy first to define a health savings account, and this is for qualified medical expenses and it's tax exempt. But to be eligible to fund one of these, and therefore to take the deductions, a taxpayer must be 65 years or younger, and I'm saying that wrong, really they must be younger than 65. Let's say 64 or younger. They must be self-employed, or they could be the employee or spouse of an employer with a high deductible health plan. And your textbook talks about what qualifies as a highly deductible health plan. Basically, the idea here is if you're having to pay a lot of expenses because your deductibles are so high, you may be able to use a health savings account. You must have no other health care, such as Social Security. You can't be a dependent of another taxpayer, and this account has to be provided for with the use of a trustee. So in theory, certain people could be their own trustee, but this thing has to have a trustee. Moving expenses. These are moving a household, including household goods and personal goods, from an old location to a new location. Traveling, so if you're traveling from the old location to the new location, as an example, this isn't fully inclusive, but lodging is a deductible moving expense during the trip. Meals during the trip are not a deductible moving expense. Temporary storage when you're in the new location or as you're leaving the old location can be deductible if they're for a consecutive period of 30 days. Typically we think of these as being in the new location if you get there and have to put them in storage while you're waiting for your house or apartment to come open. These are fully deductible if they meet 3 tests. One is there must be a change in employment. This does not mean you have to switch employers, but it does mean you have to switch locations. Your office has to switch. The distance has to be 50 miles farther from home. So for example, in our area, if my office moved from Portsmouth to Williamsburg, that might be 50 miles. But if my house, it doesn't really matter that the new location is more than 50 miles from my house. What matters is the difference between Williamsburg from my house and Portsmouth from my house has to exceed 50 miles. Time. There has to be a certain amount of time you're employed afterward. In other words, these are moving expenses for employment, not just casual moving expenses. So, if you're employed 39 weeks in the 12 months after you move, then the moving expenses are deductible. If you're self-employed, the IRS recognizes that under some conditions you may need to move to seek work. But in this case, the test is 78 weeks in 24 months if self-employed. So normally you can take these items as a deduction. And then later, if you learn that you didn't qualify for the deduction, for example, if you got laid off or quit, then you either have to add them to adjusted gross income for the next year you're doing taxes, or you can do an amended return on the old year. Deduction for half of self-employment tax. This is one of those things that people don't often understand. And it's really remarkably easy to describe why you're doing it if you just think about it. So if you work for somebody else, then one half of the FICA, the Social Security and Medicare, you have to pay, and one half of the Social Security and Medicare your employer has to pay. Well, that's what we call self-employment tax for a self-employed individual. So when you look and you see that in addition to income tax, a self-employed person has to pay self-employment tax, that's because that person's paying their own 7.65% FICA and the employer's 7.65% FICA for a total of 15.3%. But the idea is the employer could get, if you're working somewhere else, your employer would get a deduction for the amount they're paying in FICA for you. Therefore, you as a self-employed person ought to get the 7.65% deduction. Early withdrawal of savings is remarkably simple. We're in a very low savings rate environment right now. When rates get higher, you often see bank CDs are a more popular form of savings. And a bank CD will typically give you a high rate if you leave the money in there for 1, 3, 5 years. If you price those, normally a 5-year CD is better than a 1-year or a 3-year CD. But typically the bank will have, and this is not a legal document, it's a bank document, the bank will have a document that says, that you sign, if you withdraw the money before the 5 years or before the 3 years, you might have to pay a penalty. So as you're recording, as you're receiving interest on this CD, you're recording the interest in your adjusted gross income. Therefore, anytime you get a penalty like this, you're able to deduct the penalty from AGI. This is kind of like a net of the amount that you received as interest. And let me clarify one thing. It's not relevant to tax class, but I just don't want to say something wrong. The bank does have you sign a legal document, and I said they didn't. What I'm getting at is the document is not required by law. The bank has chosen to come up with a CD document that complies with the law, and it says you pay a penalty. Alimony. This is quite a simple thing. Alimony is basically income subsistence. So, for example, it was more popular in a time where there was a non-working spouse. And so spouse and non-working spouse had children. If they got a divorce, child support covered the cost of the children. And alimony was like an income supplement, recognizing that the spouse that wasn't working may have chosen to not pursue a career to take care of the children. Alimony still happens, so I don't want to imply that it doesn't, but I want to say it came out of that era. And now, if both spouses were working spouses and are working spouses, it's less likely to be a factor. However, if a court decree pursuant to a divorce says that there's both alimony and child support, then the alimony part is deductible by the payer and income to the recipient. Now, I have a child, and she's an adult now, but just turned an adult. I don't get to deduct her food or anything any more than I would deduct my own food. So child support is supposed to cover that stuff, and it's not deductible. Alimony is deductible and includable. Child support is not. Here's just a couple other quick hits as in terms of being adjustments for AGI. Educator expenses show up right on the 1040. You usually don't have to itemize to claim these, but they're only for K-12 teachers. So for example, I'm a college professor, I can't deduct them. And they're up to $250. Tuition and fees, these, and separate this from the interest we were talking about on education loans at the beginning of the discussion. Tuition and fees are basically deductions for the cost of tuition or for the cost of fees, whereas those educator loans we're talking about deductions for the interest. So the tuition and fees you can claim a maximum of $4,000, but phase out begins very low. For a single taxpayer, phase out begins at $65,000 of AGI, and for married filing joint taxpayers, phase out begins at $130,000. In a lot of the period of phase out, the deduction is limited to $2,000 instead of $4,000. But phase out is complete above $80,000 for a single person and $160,000 for somebody or a couple married filing jointly. Well, that's our discussion of adjustments for gross income. Let me know if you have any questions.